Welcome back to Insights Now. I'm David Kelly, Chief Global Strategist here at JP Morgan Asset Management. We're joined today by Noble Cooper, a research analyst in our Market Insights team, to discuss our next moment in market history, the 1998 collapse of long-term capital management. Welcome, Noble.
Thank you, David. I'm excited to be here. I have to say, I was on a 7-hour flight the other day, so I really appreciate you kind of giving me some reading to keep me entertained.
Okay, well, you got to read When Genius Failed, which is all about the 1998 collapse of long-term capital management. So we'll get into the details in a minute here, but could you just give us a quick sort of 30-second summary of what that really was all about?
Yeah, of course. So long-term capital management was a hedge fund that built these highly levered positions that were built to design to profit from the very small convergence of small pricing discrepancies across global bond markets. I'd say initially this worked very well for the strategy, but ultimately during the summer of 1998, the market faced some stress and those spreads actually, to widening rather than narrowing. And these losses mounted very quickly for the strategy. And this was further exacerbated by the amounts of leverage that the fund was using. And ultimately, it got so bad, it got to a point where the New York Fed had to step in and organize a bailout.
Yeah.
So hopefully I kind of did this justice, but I hope through this explanation, you can kind of give us more look into how the fund kind of came to be, especially because the book kind of went into detail about one of the major distinctive factors of the story is the team that was behind it.
Well, yes. So it was long-term capital management was founded by John Meriwether, who's a sort of alumni of Salomon Brothers. He'd been involved in bond trading in their fixed income desks, and in the early 1990s, he sort of left Salomon Brothers in a bit of a cloud, but he set up long-term capital management, and he got a lot of people interested in it. They actually started out with $1 billion in capital, which is a lot. But it grew very rapidly. I think one of the things they did right was in terms of marketing. They brought in two Nobel laureates, Myron Scholes and Robert Merton, who were renowned in the financial industry because, of course, they were the architects of the Black-Scholes option pricing model, which ultimately won them the Nobel Prize. So it started out at a fairly large level, and then, as you said, they were in the business of risk arbitrage, and really the simplest bets they were making were convergence arbitrage.
Mhm.
So what they were trying to do is say, look at prices which ought to be really the same, and they're a little off in two markets. So let's make a bet that they're going to converge. I remember one of them in particular because I remember I was actually working for a Swedish firm in Greenwich, Connecticut at the time, and I saw a fixed income manager basically copy this. And the idea is you'd have an on the run treasury and an off the run treasury. So the government issues a 10-year treasury. Everybody wants to buy the new issue. It's got a certain liquidity in markets, and nobody cares about the one that was issued 3 months ago. But that means that you pay a premium for that new one. But of course, that new one will turn to old pretty soon. So the bet was basically you buy the off the run treasury, you short the on the run treasury, the newly issued one. When those prices converge, you scoop a few pennies. The problem was it's only a few pennies, a few basis points. And in order to make real money out of a few basis points, you have to use massive leverage. And they borrow from all over Wall Street at very favorable rates, I should add, to make these bets. But it's kind of like gathering nickels in front of a steamroller. And of course, that was a successful strategy. They branched out into other convergence trades, other arbitrage trades, essentially going short one market, long another market, or short one asset, long another asset. And they grew very rapidly. They started out at $1 billion in capital. By the end of 1997, they were up to $7.5 billion of capital. So initially, it was very successful.
And David, they built a lot of these convergence trades based on their quantitative models. And you actually have this saying that I really have come to enjoy and kind of try to implement into my own investment philosophy. Your saying is hedging is the risks that you know, and diversified it's the ones that you don't. In the case of LTCM, on paper, I'd say that they seem diversified, but ultimately, when these markets came under stress, a lot of their positions ended up moving in the same direction. So I'm just curious, can you tell us some detail about how the biggest disconnects between their model assumptions and how markets actually work under stress?
Well, I hope and I think they weren't so naive as to believe that market returns would always be normally distributed, or rather log normal distributed. I'm a little concerned that maybe there was some element of that because, of course, the Black-Scholes model is ultimately based off a log normal distribution. So it was possible that they were under that illusion. In calm markets, of course, markets can behave in a kind of normal distribution. But the thing you got to worry about in markets, and we see this throughout this Moments in Market History series, is sort of fat-tailed events when something very bad goes wrong, and you suddenly have a return, a loss, which is way beyond what your models would expect. So possibly, that may have been one of the sort of naive elements of it, is assuming that markets are going to be continue to be relatively normally distributed and well behaved. I think another risk to what they were doing is they sort of branched out. There just weren't enough trades in the off the money treasury business, and so they branched out into things like merger arbitrage, where a merger be announced, but there was a distinction between the price the merger was supposed to close at and where the price was in the market right now. We were headed towards European Monetary Union. And so the yield on Italian bonds was much bigger than the yield on German bonds, but they should converge also. So that as their capital grew, as their leverage grew, as the amount of assets they essentially had grew, they had to make more and more bets. And they were all essentially on the idea that exploiting what looked like discrepancies in pricing around the world. But there were, I think, two problems with that, maybe three problems with that strategy. One of them was that the bigger you got, the more bets you had to make. And at one stage, at the end of 1997, they actually returned a whole pile of capital to investors because they didn't want to be responsible trying to invest money they had no good way of investing. So that was one issue. A second issue is that this works fine so long as you assume that all your bets are uncorrelated with each other. But if you have a big risk off trade, if something happens and people are just trying to get hold of liquidity, get rid of risk all at the same time, all of these convergence trades can blow out at the same time. And so you think you've got a diversified portfolio, you don't really have a diversified portfolio. And then the third thing that happened to them, and I've seen this happen in markets also, is Wall Street can be a pretty cutthroat place. And as they were getting into trouble, everybody in Wall Street knew they were getting into trouble. They've got these convergence trades, they're not converging. But wait, they're going to have to dump this trade at some stage. And when they do, this thing's going to blow out further. So why don't we bet against them? And we'll make money out of their distress. And so there's always been an allegation that when Goldman came in to help them, they also took a careful look at their books to figure out which trades to bet the other way. Now, I have no idea whether that was. It's a well-known rumor, and it was obviously mentioned in Roger Lowenstein's book. I'm not going to opine on whether it was true or not. But in general, Wall Street was kind of aware of the positions they were in and therefore bet against them, and of course made markets go even further out of whack relative to what the PhD economists thought they should be doing. If you're here for the why behind market turning points, Alternative Realities brings that same approach to alternatives, spotlighting the shifts reshaping the alternatives landscape. Hear from industry experts and distinguished guests on the strategies and trends shaping the future of alternatives. Listen to Alternative Realities today, available wherever you get your podcasts.
And as you mentioned, a lot of this leverage kind of fueled a lot of the return when markets were behaving. But on the flip side of that, when the markets kind of were challenged, a lot of the same leverage very much exacerbated the losses and made them lose very fast.
Oh, absolutely. Because once they'd returned capital to shareholders at the end of 1997, in the summer of 1998, they had about $4.5 billion in capital, call it $5 billion, but they had about $125 billion in assets. So they had massive assets, massive liabilities. That's 120 million in liabilities, 125 million billion in assets. So that's massive leverage. And on top of that, they had a derivative exposure, which was 10 times that. It was $1.25 trillion in notional value. And that made it a problem not just for them, because they were a little company, but it was a problem for everybody because they'd borrowed off everybody. So if they go under, how is everybody going to get paid? And all these Wall Street banks who had been their client, they had lent them money on profitable terms, but now they're worried, well, what happens if LTCM doesn't pay us? And then also they were counterparties on all these derivative trades that LTCM had made. So again, what happens if our counterparty shuts up shop? So what started out as a small problem for our long-term capital management quickly mushroomed into a problem for the entire U.S. financial system.
And as you mentioned, this kind of shifted from a problem for this one singular company. So say this hedge fund is very troubled. Can you kind of explain how this permeated across the market and became something that the New York Fed actually had to felt like they had to step in and contain. And can you walk about how the bailout was developed?
Yeah, so there are a number of things going wrong at the same time, to be honest. First of all, you already had the Asian financial crisis, so that's probably for another episode here. But that was a lot of the tigers of the Asian economy who've been doing very well suddenly imploded, and their currencies collapsed, and their stock markets collapsed, and that was causing a lot of stress on Wall Street. You also had the Russians default on some ruble debt, and that was a significant problem, particularly for long-term capital management, because they'd bet the other way. It was a stressful time in Wall Street anyway. And then they had all these banks had some exposure to long-term capital management, and they were afraid the market wasn't behaving particularly well. These banks were afraid that if this thing went under, it could take them down too. And so the New York Fed has always had an unofficial role in trying to keep an eye on Wall Street. And so the New York Fed did orchestrate a meeting in which all the heads of these banks came into a room, and they were all the hat was passed around and said, basically, will you put in 300 million or whatever into bailing out long term capital management? And all of them did, with the exception of Bear Stearns, which came back to haunt Bear Stearns. But it was so they did raise the money privately. There were some squawks about why should you be bailing out these people, but actually the partners from long-term capital management, they didn't really get bailed out here. They got um, ultimately most of them were ruined by this venture. But the New York Fed felt that they had to come in to control it, and in many ways, it's a sort of haunting echo of what happened 10 years later in 2008. I remember, as I said, I was working for a, fund in Greenwich, Connecticut at the time. I remember there was a significant rumor at the time that Lehman Brothers was going to go under because of its exposure to long-term capital management. Well, of course, it's again, all these investment banks had huge um, leverage themselves. They were carrying way too many assets relative to their equities. So in hindsight, this should have been, we got fair warning and last call that we needed to rein in leverage and complicated derivatives. But that call got unanswered. And in many ways, we could have avoided the great financial crisis of 2008, I believe, had we taken the lessons from long term capital management seriously.
Yeah, and I would agree. I'd say that the bailout kind of somewhat changed behavior across Wall Street and kind of signaled that if things do get bad enough, the system will ultimately step in and kind of bail out the system.
I think that's part of it, but I sort of go back and forth in this. I realize that some pain needed to be inflicted, and pain was inflicted upon the principles of long term capital management. But you can't stop Wall Street from getting aggressive and getting greedy. They will push the envelope. They always do.
Mhm.
Because frankly, if you are conservative and somebody else that takes a little bit more risk, all the business goes to the risk player. And you may be doing it all right, but you're out of business. And so what really, it's an issue not of drawing a line in the sand and saying we will not bail out because there's moral hazards and we're going to we throw somebody to the wolves. The real issue is, do you regulate leverage early on?
Mhm.
When the leverage is getting out of hand, when the derivatives are getting out of hand, what do you do to regulate that, to stop companies from taking risks they shouldn't take? Because ultimately, if you want to have a more stable financial system, you really have to regulate some of the risk away, because it's not greed, it's just the way the business works. People will take whatever risks are available to them in order to grow in Wall Street.
No, of course. But I'd say, ironically, I mean, it seems like we actually the markets had a lot to learn from the geniuses behind long term capital management. So, David, if you could boil this down into a few core principles for investors today, what would you want the major key takeaways to be from this moment in market history?
Well, I think there's one message obviously for regulators, which is you got to regulate, do your job. So we don't see exactly that kind of issue at the moment in markets, but we've seen plenty of other areas in alternatives, but particularly in things like crypto, where the government really should be stepping in and regulating, and it's not.
Of course.
So I think we need to, there's always new versions of financial speculation which the government ought to try to regulate and snuff out before it hurts the real economy. For investors, though, it is beware of leverage. It's getting rich slowly is the idea. Don't try and get rich quick by doubling up and tripling up, or multiplying by a factor of 10 the bet that you're making, because that's dangerous. And the leverage is dangerous because it works for you on the way up, but it can work disastrous for you on the way down, particularly if markets move far faster than you ever thought. And the second thing is don't assume you're diversified unless you are really diversified. Because what we saw is, if you've got a whole series of risk on assets and suddenly the market mood is risk off, then everything go down at one time and correlations head to one. And so I think people need to rethink about what it is to be diversified and what it is to be a long-term unlevered investor.
Of course. Well, thank you, David.
Thank you, Noble. And thank you all for joining us for another episode of our Moments in Market History series. We hope you'll join us next time.
This material is for information purposes only. The views, opinions, and statements of financial market trends that are based on current market conditions are those of the speaker and may differ from those expressed J.P. Morgan Asset Management or by other areas of J.P. Morgan Chase & Co. Any companies referenced are shown for illustrative purposes only and are not intended as a recommendation. We believe the information provided here is reliable, but should not be assumed to be accurate or complete. The views and strategies described may not be suitable for all investors. This content is intended for information only based on assumptions in current market conditions and are subject to change. No warranty of accuracy is given. This content does not contain sufficient information to support investment decisions. It is not to be construed as research, legal, regulatory, tax, accounting, or investment advice. Investments involve risks. Investors should seek professional advice or make an independent evaluation before investing. The value of investments and the income from them may fluctuate, including loss of capital. Past performance and yield are not indicative of current or future results. Forecasts and estimates may or may not come to pass. J.P. Morgan Asset Management is the asset management business of J.P. Morgan Chase & Company and its affiliates worldwide.